Hey, good afternoon, everyone. Marty Mazzora here. Friday, the 26th of January, 2024. This is your weekly economic update. I am going to do the usual, talk for a moment about our index score. Of course, share with you a handful of inputs. Got a few things today that I want to illustrate for you. And I want to start, though, with a little narrative on yesterday's GDP. We'll get into the inflation numbers as well that came out today. And I want to just paraphrase some commentary from an economic/strategic team who I have a lot of respect for, who pretty much nailed it last year and what they are thinking about this year. So just to get this out of the way, we actually had a really nice bump in our index. It rose 4.25 points. Still a negative 23.40, so that tells us that odds favor recession over continued expansion going forward. Okay, so GDP came in surprisingly good at 3.3%. Before we get into the weeds, we need to acknowledge that that is real GDP. So it's adjusted for inflation, and inflation actually came in notably softer than anticipated in the fourth quarter. So if you had what was the inflation expectation going into Q4, you would have had GDP much closer to what the estimate is, for what that's worth. In terms of what pushed it, personal spending added 190 basis points. That was a little bit better than expected. Government spending was the second biggest contributor, and that was almost 60 basis points. Most of that was state and local spending. They have to spend all that money they got from the federal government via those big programs, around COVID. Trade added 43 basis points. It was essentially 70 bips due to exports, 25 bips declined due to imports. Gross private investment contributed 40 basis points. Not a whole lot from residential investment, but more on processing and software. And 10 basis points was added for structures, which can be a number of different things. Next week, folks, is potentially big. You have the Fed meeting, and you have a number of things, but you also have the quarterly refunding announcement to give you an idea of the complexion of the borrowing going forward. And that's actually potentially quite the market mover. It could even be bigger than the Fed meeting next week. So that's something I suspect we'll be talking about in next week's update. It was interesting this morning when the PCE numbers came out, an hour before the market, listening to Bloomberg television and all the commentators, and my goodness, the soft landing camp is in. I mean, victory laps are being taken. And in our early morning strategy call today, I was emphasizing that barring for some crack in the financial sector, right, like we had in 2008, as we move into recessionary conditions, we pass through what I like to call soft landing valley, right? And that is something that we've been preaching for the last couple of years is, yes, we've had rampant inflation. We are in this long-term structurally higher inflation camp. But when we have a recession, it's coming down, and the Fed's going to exceed their downside target before it's all said and done. So when we see inflation softening and things beginning to develop, we're not seeing Goldilocks, right? We're actually seeing the transition, the move toward the recession. So this that's been happening lately that the market's getting all excited about is pretty much how this happens on the way to recession. I've shown you a lot of that in the charts, and some of that may pop up as I go through them today as well. Remember that I was very impressed with one of our research partners or providers that last year pretty much got it right. They have a model that said no recession last year. Our model, so to speak, doesn't give timing. It just acknowledges risk relative to the macro or relative to the economy, and it's still flashing red, as I keep showing you every week. But I'm just paraphrasing what BCA's global equity team was talking about this morning. Wage growth is a lagging indicator. If you look at the quits rate and the hiring rate, they lead. That's telling you that wage growth is going to continue to come down and probably will be consistent with the Fed's target by the second half of the year. What I'm more worried about is the fact that a lot of insulation that kept a recession from happening last year is starting to wear thin. We talk a lot about the pandemic savings and different ways of measuring it, but all those suggest that they're going to be exhausted by the middle of this year. Job openings are coming down. I've illustrated that for you. So probably within the next 6 to 9 months, people who lose their jobs are not going to be able to walk across the street and find new work. Unemployment will start rising, and that will feed on itself. More loans are maturing. They'll have to roll over at higher interest rates. So all of that is happening behind the surface, and that's what I worry about. I think realistically, it's going to be hard to avoid a recession. And then lastly, last time I checked the savings rate, it was 4% in the US, and it's actually 3.7, I think I'll show you in a second. And it was 7% in 2019, and I think the longer term average leading up to that was like 6.5%. Now, when pandemic savings run out, and savings have to go back to where they were in 2019, that implies a fairly significant decline in consumption. We all know about Keynes's paradox of thrift. If everyone tries to save more and spend less, then people lose their jobs. And if you don't have a job, you don't have an income. You can't save. So efforts to increase savings have a very, very toxic effect on the economy. Okay, so again, that's someone who said no recession last year, gives it like 80% odds of recession the second half of the year, and I will submit that stocks are not discounting that in terms of earnings expectations remotely at this point. So that's the risk we're concerned about. It's not the risk, as a lot of the bears are saying, of a second wave of inflation, and some really smart people are starting to eyeball that. And I think that happens potentially if the Fed tries too hard to avert recession. You could actually see inflation not falling anymore or actually picking back up. If that brings the Fed back in and they have to start raising rates again, then we're going to start talking about a harder landing, maybe a worse recession ultimately than we think is going to happen over the next several months. Okay, so jumping right to the indicators, I mentioned the consumer income and spending data. Here is personal consumption expenditures. You can see that was a positive, jumping 0.7% on a month-on-month basis. Personal income up, call it 0.3%. The consensus expectation was 0.3%. I mentioned the savings rate dropping to 3.7%. And then you see here, this is kind of what the gentleman was talking about. If things begin to slow down and people start trying to save more money, which is what tends to happen, right? As we get into recession, which are these red shaded areas, that's, savings, not spending, and that is a major potential contributor to the recessionary conditions. Initial jobless claims, they got all the way down to like 187 last week. They bumped up to 214,000. Still epically low on a historic basis. The continuing claims jumped up by about 30,000 as well. And remember, it's not as much about the level as it is about the change and what happens soon after they start rising. And this is one of those leading indicators that gentleman was talking about, and that's job openings rolling over here tend to be a precursor to rising jobless claims, as you might imagine. The Chicago Fed National Activity Index, you can see it's pretty noisy. We're looking for a trend. It moved back into the negative last month. It has 85 components. It's an index within our index. It flipped to only 37 positive, 48 negative. So that would be an indicator that the economy is growing below trend. I mentioned today's inflation data come by way of personal consumption expenditures. So the core, actually, which excludes food and energy, still coming in close to 3%, but Fed has to love the trajectory, right? The headline at 2.6 was basically flat, save a few basis points here, but it was rounded to 2.6 last time as well. And the headline on a month-on-month basis was up just 0.17%. So very tame and very encouraging, but expected in our view, not something for the market to celebrate if we're right about why this ultimately will continue. I wanted to look at commodities with you. This is the Bloomberg Commodity Index. There's been a bit of a pop here very recently, and you can see it's maybe trying to peak above this downtrend line and above its 50-day moving average. But folks, what we have here is a pretty bullish short-term look on commodities, and that speaks positively about the economy. It doesn't speak positively about folks who want inflation to keep coming down. But there's always going to be conflicting signals. But the fact that commodities are rising a little bit here would bolster the case of the bears who think we have another wave of inflation coming. Not our base case, but I do want to acknowledge that this is a bullish-looking pattern. You have basically a descending triangle, but you have some real bullish divergences on our chosen momentum indicators down here. You see how at the very peak back here in 2022, you had a nice uptrend, huge right here, and then it continued. But notice what happened after this point. Momentum rolled over big time, and look what happened since here, right? And here is right here, right? Kind of like today, a little different pattern, but this right here is bullish, right? This right here is bullish as well. So what you can see here is that I'm pointing to something that says here, at least technically, the way the commodity index is moving is there may be some upside in the commodity space. Raw industrials, this is one of our components. I like it because these are things that don't trade in the futures market. So this is just kind of is what it is, not influenced by futures traders. And you can see it's got the same kind of thing going on, falling wedge with bullish divergences. The staples to discretionary ratio, very short. We're just 3 or 4 weeks into the year. But this was, just absolutely plummeted last year. So this would be using the staples ETF, staples sector ETF, versus discretionary equities using the discretionary ETF. So there's a 5% difference between what staples are doing this year and what discretionary is doing. And it just means staples, which is in our top 2 sector weightings, is slightly positive on the year. It's just that discretionary is very, very negative. And of course, company earnings on a very short-term basis are going to impact this as well. On a long-term basis, this can be a pretty important indicator about the economy. One of the world's best ever investors, he's a legend, Stanley Druckenmiller. When you hear him talk about his theses, he looks at things pretty simplistically, and I've heard him over the years mention these kinds of relationships as being very critical in terms of assessing where we're going. So this right here suggests that the market is discounting potential weakness in the economy going forward. Again, we're going to need more time than just a few weeks, but that is interesting. Coming into a year where, unlike last year, everybody was in the recession camp, far fewer people are now. Everybody seems to be in the soft landing camp, but our recession light is still lit, and I just shared with you some commentary from someone whose light just got lit here recently in terms of their recession indicator. So folks, lots to talk about. I could ramble on for a lot longer when I look at all my screens and what we could talk about, but that's been long enough for this one. You get the gist. And so we'll skip stocks this time. The charts don't really look any different. The short-term patterns that were alive yesterday have just gotten extended into today. Folks, thank you as always for watching and listening. Talk to you again soon. Bye-bye.